Welcome to Earnings Digest, your go-to for everything stock market. Every week, we dive into the latest trends,
Absolutely.
highlight key earnings, and give you a recap of how the market performed this week. This week, we're getting ready for a potential roller coaster ride with earnings reports from a bunch of big names across different sectors.
Yeah.
It's your shortcut to understanding what could shake up the market next week.
Exactly. And this time we have a really interesting mix.
Yeah.
From the iconic Birkenstock to the memory chip giant Micron Technology and even sportswear giant Nike.
Right.
We're going to see how different industries are weathering the current economic climate.
First up, let's take a look at Birkenstock.
Okay.
The comfy footwear brand that went public just over a year ago. Their Q4 and full year earnings report comes out on December 18th.
Right.
And everyone's waiting with bated breath to see how they performed.
It's a critical report for sure, especially given their stock's volatility.
Yeah.
They saw a 31% increase since their debut, but then dipped after a disappointing Q3. Right. This report could really swing things in either direction.
Analysts are predicting earnings of $0.29 per share for Q4.
Okay.
But what I find really fascinating is their aggressive expansion into Asia.
Yeah.
As of their last report, Asia already contributes 11.3% of their total revenue.
What's fascinating here is the growth potential of the Asian market.
Right.
With a rapidly expanding middle class and evolving fashion trends, Asia is becoming a crucial battleground for footwear companies.
All right. It's a massive market with a huge appetite for Western brands, and Birkenstock seems to be tapping into that effectively. They're facing competition, of course, from brands like Teva, Chaco, and Keen.
But Birkenstock has something those brands don't.
Yeah.
Their iconic and, let's be honest, super comfortable sole.
Yeah.
That's their unique selling proposition, and it could give them a real edge in this competitive landscape.
Absolutely.
So for you, this is the one to watch closely.
Okay.
Expect significant stock swings after this report drops.
Now let's shift gears to a completely different industry.
Yeah.
Semiconductors. Micron Technology, a major player in the memory chip market, is expected to report its Q1 earnings on December 18th after the market closes.
Right.
And get this, analysts are predicting a massive 84% year-over-year revenue increase.
Wow. This explosive growth is largely fueled by the insatiable demand for memory chips,
Right.
particularly those used in AI applications.
Yeah.
Think about it. AI is permeating every aspect of our lives, from smartphones and self-driving cars to complex data analysis. All of that requires massive processing power, which relies heavily on memory chips.
Micron has been killing it in the DRAM market, actually increasing their global market share significantly.
Yeah.
But it's not all sunshine and roses.
Right.
They face challenges in the NAND Flash market due to falling prices, which could impact their overall revenue.
And that's where the potential for volatility comes in. Despite the positive projections, the options market is suggesting a possible 10% swing in Micron's stock price post-earnings.
Oh, wow.
It's going to be a nail-biter for investors.
Absolutely, and it'll be particularly interesting to see what their guidance for Q2 looks like.
Right.
With the AI boom showing no signs of slowing down and Micron actively expanding into the high-bandwidth memory sector.
Yeah.
They're operating in an incredibly dynamic and, frankly, unpredictable space.
For those of you interested in the tech sector, Micron's report could offer valuable insights into the overall health of the semiconductor industry and the future trajectory of AI adoption.
Right.
It's a fascinating case study of how a company is navigating rapid technological advancement and finding ways to capitalize on emerging trends.
Now let's talk about a company that's facing some serious headwinds.
Okay.
Nike.
Interesting.
The once unstoppable sportswear giant is scheduled to announce its Q2 earnings on December 19th after the bell, and the outlook isn't as rosy as Micron's.
Analysts are predicting a 37% drop in adjusted profits and a 9% drop in revenue.
Wow.
That's a significant hit for a company of Nike's size and stature.
Those are some pretty daunting numbers. They're facing a trifecta of challenges: slowing growth, increased competition, and perhaps most importantly, a struggle to maintain their cool factor, especially among younger generations.
Yeah, it seems like the newer, more niche brands are resonating better with Gen Z and millennials.
Right.
It's a classic case of a legacy brand trying to stay relevant in a rapidly changing market. And to add to the pressure, this will be the first earnings report under their new CEO, Elliott Hill, who took over in October.
Right.
All eyes will be on him and his strategy for turning things around.
Exactly. This is a make-or-break moment for Nike.
Yeah.
Investors are eager to see if Hill has a plan to revitalize the brand and recapture their lost market share, especially considering Nike stock is down 28% year-to-date.
Wow.
This report could either restore investor confidence or send the stock plummeting further.
I'm really interested to see what their international sales look like. That could be a key indicator of their overall health.
Right.
If they're losing ground in emerging markets, that's a red flag.
Speaking of companies facing challenges, let's turn our attention to FedEx.
Okay.
The global logistics giant is expected to report its Q2 earnings on December 19th after the market closes. Analysts are predicting a modest 1% year-over-year increase in adjusted earnings, with revenue remaining flat at $22.2 billion.
These projections might seem a bit underwhelming, but keep in mind, FedEx has been making significant efforts to improve its bottom line through cost-cutting measures. Their DRIVE program, which aims to save $4 billion annually by 2025, is a key part of their strategy.
Yes, that DRIVE program has been a major focus for them.
Yeah.
But like many companies in the logistics sector, they're still battling rising fuel costs and labor shortages,
Right.
which are putting pressure on global trade in general.
These are industry-wide challenges that are difficult to overcome, even with the most ambitious cost-cutting initiatives.
Right.
It'll be interesting to see how FedEx navigates these headwinds and whether their DRIVE program is enough to offset the negative impacts.
It's a tightrope walk for sure.
Yeah.
What's intriguing is that despite missing earnings expectations last quarter, FedEx's stock is currently near all-time highs.
Wow.
So this earnings call will be crucial in determining whether they can maintain this momentum or if reality will finally catch up with their stock price.
Investors will be looking for reassurance that FedEx is on the right track and that their cost-cutting and efficiency efforts are truly effective in addressing these industry-wide challenges. Any sign of weakness, and the stock could take a tumble.
Now let's move on to Accenture, a leading consulting firm that has been riding high on the wave of AI and digital transformation.
They're scheduled to release their Q1 earnings on December 19th, and unlike some of the companies we've discussed, they're actually expected to do quite well.
That's right. Analysts are projecting a 2 to 6% revenue growth for Q1.
Wow.
Which really highlights the strong demand for their services in this digital age.
Yeah.
What I find particularly impressive is their success in the AI space.
Right.
They reported a whopping $1 billion in new AI bookings in Q4 alone.
It's a testament to how effectively they've positioned themselves at the forefront of AI and digital transformation. They're not just talking the talk, they're walking the walk, securing major contracts and delivering concrete results for their clients.
And they're not just focusing on growth. They're also committed to rewarding their shareholders.
Right.
Accenture planned to return a significant amount of cash through dividends and share buybacks.
That's always a good sign for investors.
Yeah.
It demonstrates confidence in their future prospects and their commitment to delivering shareholder value.
Investors will be eagerly awaiting their full-year outlook. Their current projection is a 3-6% revenue growth, which, if achieved, would solidify their position as a leader in the consulting space. So as we've seen, this week's earnings reports will offer a fascinating glimpse into how companies are navigating a landscape marked by both challenges and opportunities.
Yeah.
We have iconic brands like Birkenstock trying to capture the Asian market,
Right.
tech giants like Micron riding the AI wave, and legacy companies like Nike struggling to stay relevant.
It's a reminder that the market is constantly evolving and investors need to be aware of the various factors that are impacting different sectors.
Right.
The companies that can adapt, innovate, and respond effectively to changing consumer demands and technological advancements are the ones that will ultimately thrive.
So stay tuned, folks. We'll be back next week with another deep dive into the latest market trends and earnings reports.
Right.
And in the meantime, keep learning, keep researching, and happy investing. They'll give us a better sense of which companies are thriving in this new environment and which ones are falling behind. And with that, we wrap up another deep dive into the exciting world of earnings reports and market trends. We'll be back next week with a fresh batch of insights and analysis. Until then, happy investing.